So it's all about a live term sheet negotiation. So we're going to have an investor, a lawyer, and an entrepreneur. Sounds like a joke, but since I'm not a comedian, I will not say that. But this is going to be good, and I want to invite out Lars Buch, who is from StartupBootCamp, and he's going to be running this session. Lars, are you there? Yep. All right. Come on out. Round of applause. Good luck.
Coming through? Now it is. Good to be in Milan, even without slides. That's going to be painful a little bit later in the show. No? Okay, but they're probably coming. Good to be in Milan. I'm from StartupBootCamp, the biggest accelerator in Europe, measured on number of programs. We have 9 programs right now, and we're expanding with even more programs over this year. So we are accelerating more than 100 startups per year. I'm not going to talk too much about StartupBootCamp. We are proud about the latest numbers, and we are trying to drive a new movement in Europe where we put all our basic statistics on our webpage, so everybody can go in and see what is actually the results of the accelerator. Really important when you have several hundred accelerators to choose from out there. What we have for you today, at this very tough time slot between now and lunch, we will try to do an effective show so to keep you in the seats and get you even more hungry. What we have is what we call Investment Lab. So it is basically a on-stage negotiation between a VC, a startup who also brought his lawyer. What we see in StartupBootCamp is that we see a little bit more than 4,000 applications from young startups per year. And what we see as a trend is that for most of these startups, they have never ever seen a term sheet before. And when suddenly they are faced with a term sheet and especially the terms inside, they are kind of a little bit in shock. There's of course the important things to clarify especially with an institutional investor, like who is in control, how do we divide the cake if we are successful, and so on. But there are also really standard things like what do we do with if a founder leaves the company. So something that should definitely be discussed in very early phase. And one of the reasons we are running Investment Lab here is a little bit to push startups to at least take a founders agreement and take that up and discuss it in the young company. Then you're not as shocked when you meet a institutional investor. I will bring in the crew for the day. You already met Jimmy. I hope that they are hiding over there and are coming out now. You already met Jimmy from Sunstone Capital. He's here taking the role as the VC. And then we have Massi, who is from the Bird office here in Milan. And then we have Mirko, who is from the startup Fubles, taking the role as the entrepreneur today. Here, give them a big hand. Yeah, should we rearrange a little bit?
The pink chair.
Yeah, take the pink one. So we are going to need some slides up here to kind of allow people to follow what's going on. But let's get started here by saying that the entrepreneur here have had a meeting already with a VC, and they have a company that is rolling, early phase, but right now they believe that if they can raise a round of 400k euros, that will give them enough runway to come to the next value inflection point and start really running the company and increase the valuation, and then raise a much bigger round. So that's the opening from the entrepreneur. The VC here have sent a proposal for a term sheet back, which is a little bit more money, which is not abnormal, but they will come into that discussion. I think it's fair to mention here that this is not real life. Also, to be fair, also to Jimmy here, you saw this morning that he's actually a very nice guy. And what I have asked him to do here today is don't lose this battle, right? You need to walk away here with the best possible deal. And then, of course, we have an entrepreneur that are interested in the money. As we heard also with the keynote earlier say that VCs, they are our friends, but they have an agenda. So you should imagine here a friendly environment where everybody is actually trying to land a deal, but we need to set the terms right as well as we now can. Okay, guys, but why don't you guys shake hands on this negotiation meeting, and then we get started. I will jump in if I think somebody is treated unfair.
I only shake hands when the deal is done.
This is kind of just a good morning thing.
Okay. Good morning.
If we can have the slides here, would be really nice. So people can actually follow the clauses. What we normally do is that we hand out the detailed term sheet that is sent by our friendly VC, but we haven't done this today because we have very short time. We will simply run through the term sheet, and you are hopefully at some point able to follow the clauses in the back. All really listen well. Guys, take it away.
Good to meet you again, guys.
Ciao, Jimmy.
Ciao, Mirko.
Thank you. Thank you for this meeting. Thank you also for this term sheet.
Fantastic term sheet.
Wonderful. I brought Massi with me just to support me because we want to go through some points.
So how old are you?
35.
You're old enough to handle things yourself. You don't need your bodyguard anymore, I suppose.
I told him, but he didn't want me to come along.
I thought we could trust each other, right?
I'm not a friend, you know. I'm your friend.
Okay. But it's a little bit disappointing. I thought we should just do this in a sort of a more informal form.
No, you will see that Maxi can be very happy.
It's a very simple offer, so.
I do believe so.
Yes.
But let's start from one thing. We were looking for 400,000, and now you're proposing to double the amount. I have this feeling maybe you know something about the business or our needs more than we do. So could you please explain me the rationale? Why? What is the reason you want to put more money than we ask?
But I thought you wanted more money.
No, well, sometimes if you double the valuation, yes.
Okay.
But to tell the truth, we have calibrated the amount on what we believe we need. But maybe we are wrong, and you are saying in this way that we are wrong in some way? Or?
Yeah. So usually for seed, I would say you run with 18 months of runway, and you're suggesting 6 months. So I cut it in the middle and said 12 months. Of course, it takes you 6 months just to raise the next round. So I doubled the amount and said if you have 12 months, then at least you have 6 months to build your business.
I know 6 months.
But would you rather negotiate with me when you're running dry if you still need more money, or would you rather do it now?
No, I'm pretty optimistic about how we are going. You know, we started only 7 months ago. We launched it 3 months ago. So we have a good trajectory, and
but it takes 6 months to fundraise, to be certain.
I know
So you should start now raising there.
I know.
You should build your business.
I prefer to focus on the business. That's true.
That's good. So we have a deal. 800.
But let's put it in this way. I believe we are raising the value in very few months of the company. So probably this valuation is incorporating. Is not going to incorporate the value we bring. I prefer.
All founders say that.
I know that.
It's just a time issue.
Maybe it's true. No, I see an opportunity to focus on the business in the next 6 months. So I see also an interest. If you want to put more money, it doesn't mean only that you want more stake. And even if you want more stake, that means that you believe in the business. Yeah. So this is a good point. But I also want to keep the health of the company, also in terms of shareholders and the trajectory. So at this valuation, maybe such a stake now could be viable unless you tell me why.
But you're 7 months old, and I guess you invested at par value, and now you want me to pay more than 2.5 million euros for a 7 months old company that just launched a product in the market. I think that's a fair value. And I think a 20% stake is a good stake.
Don't believe it.
Well, I believe that the valuation could be the point where we can meet, we can find a...
So what do you have in mind?
A bit more?
Define a bit more.
I'll tell you after we have touched two other points, because I believe they impact on the valuation and our dilution.
It's a package, so let's discuss the other points.
Yeah, I prefer that in my case, personally, I prefer that the profile risk of the company should be in the valuation and not somewhere in the clauses of the term sheet. In particular, we have a warrant scheme that I agree with. It's a 15%. That means that we can have this 15% of the company available to hire people, to incentive. I agree with that. 15% is a good term, but I'd prefer, here I see that it's all on us, on the previous shareholder, not on the new investor. And I believe that we should share this dilution and this impact at the end on our dilution and on the valuation. So the valuation is not really that one.
It's one of the two.
The valuation is not really, it's a fully diluted valuation of 2.4.
Yeah, at the end, that is, so I prefer that this valuation could be higher, so that valuation could be also our valuation.
Or not fully diluted.
Or not fully diluted.
So you want the non-diluted pre-money of the same. So we should share the 15%.
I propose.
Why do you think that is fair?
So, because after that we are on the same side of the table and we decide together who's better.
But I'm proposing after that we are on the same side.
Yes, but the impact on the dilution is on the founders. So you need to understand that you have the shareholding and then you have the dilution due to the...
But sharing 50-50 is not fair, because I think you want to hire a team right now, and I think you should probably already have allocated more to some of the employees already. And I think you should cover that part, and then we could share the other part. So I would rather say that we either reduce the valuation and then we do it on a non-diluted basis, or that you are allowed to have some of the dilution and then we share the rest, if you follow me.
Yes, I follow you. Yeah. But we can of course, I don't know how many people you need to hire, but we need to evaluate if 15% is,
But at the end of the day, the valuation I give and the stake that I get, the fully diluted stake that I get is the only thing that's relevant to me, because you will use the 15%. So the stake that I get, I have to take into consideration that in the future you will dilute.
So you can increase the valuation.
Depending on what we agree on the warrants.
Well, to tell the truth, I don't want to put me and my team in the situation that I suffer deciding how to allocate this 15%. And the time is we have 6 months, or no, I mean with 800 maybe double the time, but I want us to...
Do you really need 50%?
What's this? Speak up so they can hear you.
Yes, so if you want to, we can take away.
What would you say if we don't agree to do that together? What would you say if I say no warrant scheme then?
No way, I would say.
So, I mean, there is a reason,
That's a much higher valuation.
Okay. I understand, but I mean, so you agree that there is a good reason to do that for the company, for the project. But
I think 15% is quite normal, to have a warrant pool of 15%.
You can ask to allocate some as up to you.
Some
warrant, some option to you.
Well, not really. I don't think that my team would agree on that.
The council and the client doesn't agree.
5% to you and the rest to the team.
No. I believe I really need to be free, to be confident on how to use that. Even if
so, what's your counter proposal? You said you had the valuation. You want to discuss 2 other points. So, what's the other one?
Oh, the other one you have to explain me, maybe, because here it's not very...
You have a counsel that can explain that.
No, but I'm going to ask you the reason. He explained me how and why you say something. Here I see that there is a reverse vesting Can you explain me again what is this reverse vesting?
Yes,
Because
the reverse vesting is the vesting of the share after the closing for
Martin?
you guys.
Just for the sake of the audience, that
Yeah.
I know it's an intimate discussion, but it's okay to talk a little bit louder.
And it's first of all in Italy is not possible. So sorry for that. It's not possible to do this reverse vesting in Italy. So what
We can find other solutions.
Yes, the other solution, legally speaking, is to have 100% vesting since the beginning, and then we can discuss if we have some bad lever. Maybe.
Only bad lever? I don't think so. Also
Why?
good lever. But anyway, the reverse vesting is a mechanism that we would like to see because we invest in you as the team. And if you're not there to run the company, we don't really have anything to invest in. So if you don't believe that you could stick around for 4 years to build your company, maybe we shouldn't have this conversation after all, right? So it's basically saying you're committed to this for 4 years. If you're committed to it and you don't commit crimes or other bad things like a bad lever, then you should be all fine.
Yeah, I see. I agree with that.
It's very customary to have these things.
No, not the reverse vesting, the bad lever. Yes, it's different concept.
Well, it's part of the key man clause. So
Yeah.
yeah.
I agree in general. Also from our perspective, not only mine, but as a team, that we are a young team. We were formed just some months ago. We don't know really if we are going to be stick together 4 years. So some investing is something.
If you cannot commit to that, I'm not signing any term sheet with you guys.
But it is very this scheme is pretty impressive. You say for 1 year we don't even know own the company.
Yeah.
So there is this cliff that we get 20% only after first year. Then in the other 3-4 years we
But that's
recover
because
that.
if any of you leave before that, as an investor that came with all the money, we need to go out and replace you and create a new incentive structure for the people that needs to run your former company.
Yeah,
So I'm fixing your problem.
but what about the value created in the first, for example, so far?
That's the pre-money.
This is the pre-money. So
Yes,
what
and
is
the
the
other
value?
one is the future.
Our pre-money now is 0.
No, it's 2.4 million fully diluted.
There is not the price also of the vesting, of the call option or the vesting, So if we implement the legally binding and enforceable mechanism in Italy, you have to put a call option and not a reverse vesting. So you have to negotiate the price of the shares to buy in case of bad lever, and I'm not sure to agree on this on
Yeah,
good
it's
lever.
difficult for us now discussing at what price.
Fair market value.
Fair market value is fair.
Fair market value when you leave. That's a good one.
But
I don't think so.
For sure, we even if we meet on this, we will need to understand what happens in some situation, like some in the exits or some in the liquidation. So is there any form of acceleration? Because I haven't seen here on this term sheet.
In the vesting schedule?
In the vesting schedule.
If you make a great exit of, let's say, 250 million euros, in year 2, we can figure out a reverse accelerating vesting program. That would be okay.
Thank you
It's
very much.
better to figure out now.
Very market standard.
Yes.
So you should-
But I mean, so it's coming down to the valuation, the warrants, and then the reverse vesting. So what's your proposal?
about the valuation, what would you say?
But it's a
To
package,
increase
so
to
tell me what
increase
you
the
want.
valuation and to skip the reverse vesting into a call option in case of only to bad lever, not good lever.
Yeah, I don't like good liver.
It's not matter standard.
No, so
in
far.
Italy.
So I would say, let's.
In Italy.
In Italy, it's a very good excuse every time. So, I would say the valuation can go up to 3 million.
On a fully diluted basis. We're not talking both 3 million and non-diluted, right? So 15% warrant pool and 3 million. Is that what you're saying?
If it's 3 million and
Not for me. I'm a lawyer. I'm not, I'm not.
Okay, let's
I
put
will
in
math,
this-
but you need to decide. But I'm sure that the impact on the dilution on the ESOP is much more than the increasing on valuation. So please do math before negotiating.
Okay.
Let's do
I'm not fully clear on what it is you want to achieve, but why don't we keep the valuation and then we reduce the option or warrant pool to 10%? Then we have shaven off 5% dilution of that.
Exactly. For me, it's better.
Okay.
Also for the team, I don't know if the team is.
So we
happy
keep
with this.
2.4
We keep 2.4, but we reduce the warrant.
only to 10.
Yes. So it's less dilution, 5% less total.
Okay.
And vesting.
But the vesting?
Oh, and then what?
I mean, of
The
course
vesting-
we have to do the Italian way,
The
100%.
Italian way. So what does that
but I would say that at least
So let's discuss about 100% vested at the time of, at the closing date, and then a call option in case of the deliver at
Over how many years?
5.
5 years. So we have call options.
Yes.
So we can draw
With a
in,
decalage.
in equal installments.
Now 50% at the first year, and then you decalage
50%.
of course.
How much do you own of the company today?
and now I own 30%.
So 15%.
Oh, 50.
5-0.
50, yeah.
So you vest 50% already after the first year.
After the first year,
After
yes.
the-
Because
yes.
it's a difficult one.
So
It's a very-
I'm willing to go. We have this. We call a cliff, where the first year, if you leave, we'll keep the 100% of your shares. I'm willing to go away from that, but year one is 25% vested, not 50,
25.
and then equal after
Probably-
on 4 years.
Probably you need another round in the future, so next year. So you need to negotiate also with the further investor this kind of provisions. So
Yeah,
please
this-
be aware of this.
This is probably something that put me in difficulty. If it's true that we are going to, in this trajectory of new rounds, that we are going to build together, I hope.
Yes, that we will.
This is something that we have to expose to the new potential investors.
The vesting schedule.
They are going to renegotiate
And
anyway.
so, what's your concern?
The concern is
is
they use it.
further
They use
investors.
it against the team because the investors already have it. I know that if we already are vested, the new investors can ask us to do again a new investing.
They start again another period
true.
of.
That's true. I think I don't think anyone will be surprised to see a reverse vesting schedule in here. The question is more than how much.
With 25 vested.
Okay,
yes.
so then I have another proposal. It's 4 year in equal 25% installments. So after 4 years, it's fully vested. And I will even put on that if you make an early exit, let's say above 200 million euro exit, then we will accelerate the vesting up to 80%.
Also in case of future round financing at a higher valuation.
No, not in terms
At a
of
higher
future.
valuation.
No.
No, you wouldn't accelerate completely the
No, but
vesting.
that's going to be a rediscussion with the new investor what they prefer. So I cannot make that call right now. That will be a discussion that we will have with them in the future.
You can skip the good lever and we take only the bad lever.
This is my very
So
point.
what do you find as a good lever? When you die is a good lever. That's
Exactly.
lawyers.
When you die is good lever, and also when you dismiss with the approval of the board, and so in agreement
leave
with the
peacefully.
parties, etc.
But if you if bad lever is when you do bad things, right? That's why it's called a bad lever. So what if you decide to leave the company? What's that?
In agreement with you or without any agreement? So with the dancer from Brazil, or
one thing is if the board fires you, we can disregard
with
that.
fault or without
Yeah,
fault?
that,
It
then
depends
you would
of
be a
the
good
case,
leaver. So if you decide to leave,
in Italy you are okay, no problem. Because
but if you decide to leave, I still have a problem with just accepting only the bad lever. So if we can accept that if you leave and the bad lever clauses, I can live with it. But
If
you
you
will
leave
be,
with-
you will be vested. You will have all your shares if the company terminates you as a good lever.
This is a good level.
Not if you fraud or
So
other things.
we can amend the term sheet with this definition.
Yes. So usually we have that we call the no-cause lever. When you just decide to leave, we call that the no-cause lever. And the good lever is when we fire you, or something happens to your family, or you are deceased, or whatever. That's a good lever. So we usually have bad lever, no-cause lever, and good lever.
For me,
Yeah, it's
okay.
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 So the rest is, we have 15 minutes left to negotiate a term sheet, so I guess we're already getting there.
For the sake of the audience in this case and this negotiation, we have 10 minutes to really go through the clauses very shortly, one by one, and just check off that you actually agree of the term sheet proposal from the VC.
I thought we already agreed. That was the two other things you had aside the valuation, no?
No, this is the main issues, you know. And you
It's
need
Italian style,
to go
we keep
inside.
adding things.
This is the main.
I asked you how many things
we
you
can
wanted
negotiate.
in. I asked you how many things. You said you had 2 things aside the valuation. I thought we could agree on the rest. And now you put in more, so we renegotiate the whole thing. We don't have more than 16 minutes and 4 seconds.
Well, if you have your packet dinner, we have time.
But I'm flying on.
Okay. Now, I would go through a very important clause. I think, at least from my point of view, maybe I'm wrong. That is about the board members. I see here the governance. Yeah.
The governance.
Yeah, I see here 4
just
board
for-
members of 4.
Just for the audience and for you, it's a standard protection to have board membership for venture capitalists. Of course, they are minority investors, so they need to be also in minority position at the board level. So I'm not sure that the term sheet reflects this kind of
Yeah,
standard.
here
council
it seems
agrees.
like we could be 2 against 2 if we don't agree on the business. Or
But have you seen the companies where you have 2 against 2? That's 50-50, and you get nowhere, right? Nobody takes a decision. So what?
I don't want to be stuck in that situation.
But
How
I have
do you
solved that
manage?
because we actually appoint the chairman, right?
So you want to...
So the chairman
But-
usually have the casting vote if you cannot disagree.
Okay, that's fine. So why don't you get 3 out of 4? So that's the same.
So you want for this small company, you want to have 5 members of the board?
I need 3 board members because
Only 3 board members.
from your
and,
fund.
and
because-
you decide the 2, or
so you can help us better.
so you decide 2 and I decide 1.
Yeah.
so you are still
just
in control.
one
Yes,
and
but
3 board members.
you have the veto power.
The veto power. I tell you what, I have a proposal for that, and then we are probably done. So you decide on 1 board member, I decide on 1 board member, and we jointly approve the chairman. So we actually have an independent chairman that looks at the best interest of the company.
What does jointly mean?
We appoint, one of us appoints, but the other one has to agree.
If no one agrees? Or
Then you will have to keep looking until you find one way you agree. That should be possible.
This is
Unless
fascinating.
there's no one in Italy, of course.
This is fascinating. I could do that. I propose and you accept the 3rd one.
Whatever. We can do that as long as I accept.
It's
It's the same.
no. If I propose at least a range of names, but to tell the truth,
Okay, he can choose in a list of 5
that I
names.
propose. But this is
And
fine.
then if you don't agree on any
Then we
names,
need to find
we
other
decide.
names.
No, we decide.
No. Because then you de facto still have 2 and I have 1.
I can put my.
I want the chairman to be an independent part that takes the best interest of the company.
What's your concern about about the governance, about the board
The
members?
board should be also constituting of members that are not shareholders or representative of shareholders, which is good governance, I think.
Does it work?
Yeah, it works.
I have to think about that because
But I mean,
agreement-
you can
you
choose
are in
people you
agreement with
trust,
the other
and if I think
founders?
they're good,
this is something that I should discuss with
after
my
having
founders,
drinks with them and so on.
because we were already making the names among the founders, so this is something that
The
I cannot.
founders should be on the board.
Founders, yeah.
No
but-
way.
Ah.
You can point to people, but if you're in the management team, you're not on the board.
If you have a membership of 3, a board member of 3, we have not all the founders on board. So
We
So you
already
both
have
want to be
chosen.
on the board and in the management team. That must be the Italian structure.
Look for the the shares, the stake you're getting in is 30%, up to 25%. I would say that proportionate governance should be 2 to 1.
But I'm coming with all the money.
I know that, and we are coming with all the energy.
And I'm arguing that we should do this business together, and we should each have a vote, and then a chairman, if God forbid, if we cannot agree, it's an independent part that will look at the interest of the company and not any of the shareholders.
I know, but I'm thinking about the mindset of this young team that should be not focusing on how to convince.
Is this the last point that you have?
No.
No.
This is going backwards.
This is Italy.
No, to tell the truth,
We start negotiation.
It's going to be a
China,
long
Italy.
no, it's a picturesque termsheet in some ways. So we only have to choose. We cannot choose all the things, but these are the main points I would focus on at the beginning.
You need to focus also on the liquidation preference, anti-dilution.
Yeah, there you tried.
So liquidation preference means that in case of exit, in any exit event, the venture capitalist raised the money first, and he raised a lot of money because he is 2 times participating prefer liquidation preference.
Plus a hard
rate.
So 10.
I think, Marci, it will make sense for everybody if you explain in kind of plain language what a liquidation preference is.
Yes, basically means that the venture capitalist wants to get back the money first in case of any exit event. That means either in good or bad scenarios, so liquidation of the company or exit through other kind of trade sale or IPO or something like this. This is really market standard for any kind of VC deal at seed and Series A or Series B level. So it depends of the kind of liquidation preference you have. So you have different kind of liquidation preference. So one of the strategic tip is just to negotiate the right liquidation preference in this case for the founders. So the lower the liquidation preference is, the better it is for you, of course. So just for that, for the audience now, the venture capitalist propose a 2 times liquidation preference. That so means that if we put in the company 100 euro, he get back first 200 euros plus another later, so an accrued interest of 10%. So this is, and after this, he participate pro rata to the distribution of the capital gain. So that's totally, and this is on top of the valuation, etc., etc., etc. So it's really, something really aggressive.
It's aggressive. I mean, if things go very well and we become a billion company, this preference is going to be diluted in a very good exit for everybody.
Exactly. So it's not super important.
But
no, because the liquidation preference is ranked also in case of future round financing.
Yeah, exactly.
There is another liquidation preference of top of this. So the market standard is the new venture capitalists come in.
Yeah, in
he
fact,
put another liquidation preference on top of this liquidation
build
preference.
the stratification of preferences, and I don't even know later what is a good exit, for example. And especially if it comes to be a potential exit that is not a billion company, but a medium average or exit, then at that time we are going to be misaligned. Maybe as a founders we are going to stay there and say no, let's wait for a better exit because we are not getting anything.
We want to secure with the liq pref that we suggested, we want to secure that if it's a lower exit, that we get a decent return on investment. That's the motivation for that. In a big exit scenario of 200 million, 2 times 800,000 is 1.6 plus a little bit of hurdle rate. That's so 2 million out of 200 million.
That means
that's nothing.
You can propose 1x, 1 time liquidation preference, non-participating prefer. That means that all the future money you distribute, you take all.
I like that.
I don't like that.
No, I see that that's fair, and you can see from my point of view. It's fair.
Okay.
And anyway, I believe that in terms of exit, these things are going to be renegotiated anyway with the buyer because he doesn't want us to be I mean,
Because
don't
just
participate in a good way in the exit.
Just for us, I don't know if you plan to exit just after this kind of round of financing. So the risk of the venture capital need to protect is the risk of liquidation of the company, winding up of the company. So he needs to get the money back, not to get money on top of the money back. So the risk of liquidation is covered by 1x liquidation preference,
So you
non-participating
suggest
preferred.
1x.
1x non-participating.
No participating. Is this your last point?
No?
Okay.
It's just, no,
Tell
just-
me the other things.
No,
No,
I
the
don't
other
think there are
things-
many more.
There are many more.
No, I don't think there are many. No.
There are not many more.
Another point is the anti-dilution. That means that in case of future round of financing...
Maybe you...
Yes, sorry, the anti-dilution protection for a venture capital is another standard protection for venture capitalists. That means that in case of future round of financing of the company at a lower valuation than the valuation of the investor, then there is a mechanism just to try to balance the stake of the investor to the stake of the new valuation, of the higher valuation, or the lower valuation. So basically the dilution is on the head, on the neck, and on the shoulder of the founder. That's basically another protection on top of the valuation, on top of the ESOP, so the options pool, and on top, of course, of the liquidation preference. So it's standard protection, but we can negotiate, of course, the kind of anti-dilution you can have, and you can have also some protective mechanism, for example, to try to negotiate a pay-to-play provision. That means that there is a vesting for...
The point is, we are doing a down round, things are not going very well, we have to find together a viable way to go on. Maybe there is a viable way, and there is a third party that is agreeing with this viable way. I don't think that this viable way should be totally on the shoulder on the founder.
So what's your suggestion instead of what I've proposed?
My suggestion...
I propose a full ratchet anti-dilution, which means that a new investor coming in at a price that's half of what I paid, the original investment that I have made is also now at that half price. And new shares will be issued until that statement is true. So I take the full effect of a down round from the founder.
I have two amendments. One is, first, you should follow. I need you to demonstrate that you find it a viable way to. So I need you to follow, you say?
So the pay-to-play, is that called? Yeah,
exactly.
So you want the pay-to-play?
One is that
the dilution works only in case you invest your pro rata on future round of financing. That means that you can lower the impact of.
So that we are not.
So we keep it like that.
No way.
No. This is just one of the two suggestions we have for you.
That's suggestion.
Yes.
The second and last point of this point is we should find a middle, so a weighted valuation.
Weighted average.
A weighted average, right?
To share basically the
Weighted average pay-to-play.
Yes.
So we.
And then we
It's
still
quite standard-
keep
it's
the 2x,
quite standard
the
in
2x
Italy.
liquidation preference
It's quite standard in Italy.
with participating preferred.
Yes.
We keep 2x
No,
liquidation
it's
preference.
1x non-participating.
You cannot
plus.
have it all. You have
No,
to
we
negotiate.
leave the valuation. So
And then you salamied me afterwards, right? Yeah, good. No, I think we keep the 2x liquidation preference with participating preferred, and we do the weighted average pay-to-play anti-dilution. You get that, I get the other one.
it's better the liquidation preference.
It's better
To negotiate the liquidation preference, don't enter.
We're out of time. Should we
no,
sign?
it's the.
Or we can choose. We can propose all the pay to play, please. If in case you can have a liquidation preference at 1x non-participating
1x,
plus.
yes, and
You're
pay to
wasting
play.
pay
your
to
audience
play
time.
on
You should have,
anti-dilution,
you should have discussed this.
So we can
before
leave the. If we agree on all, there are other things here we have to discuss because so. we can
let
just
me
have
check.
The last. Let's put all together and then.
3 minutes and 30
Yes,
seconds.
my fees.
Your fees.
Yes.
Oh my God.
Okay.
So you guys
if-
are pushing for agreement, or do you need another meeting?
No, I believe that we have all the points together now. That means that we ask only for. It's not.
Okay, let's see if we can finalize this in 30 seconds.
Yeah. Okay. Listen.
Weighted average pay-to-play anti-dilution. You'll get 5,000 more for your fees, euros. And we keep the 2x liquidation preference participating preferred.
No, I would say the opposite.
The opposite?
1x, you fall, no participating, 1x.
No, that's not acceptable. I'm giving you on the anti-dilution.
Yeah, no, I can leave you the anti-dilution.
So 1x,
not
okay,
weighted.
1x, 10 seconds. 1x with the participating preferred. And what I just suggested on the anti-dilution. He's nodding. We have a deal. He's still negotiating. It's a good deal.
I'm not sure.
You're not sure?
We can talk together after, and we can email him.
Okay.
in a few days.
I believe we are.
I think
High
maybe,
level, we have a deal.
I think maybe that's also a good point to point out here, that you are in a term sheet negotiation. You still have a shareholders agreement to sign. So you will come back to this again.
Exactly.
Yeah,
You need to discuss with your founders.
I believe we are. But then if you do 3, 4 times, you don't close deals.
I'm not flying in and out of
No,
Milan
it's
all the time. You know.
But what about
we talk about
the specular one? 1x, no participating?
No. We already agreed. I already gave you all the other things. If you want the deal now, it's now. 1 minute, 30 seconds. Do you want a deal, or don't you want to have a deal? You have better offers.
We want a deal. We
Great.
like this. And
Good for
not,
you.
not at all
We need to
cost.
discuss on arm's length basis also the investment
So
agreement
you
and
cannot
shareholder
close a
agreement.
deal in the set time.
No, we close the term sheet, not the deal.
No, but we agree on the term sheet.
Yes,
and if
and
due
then-
diligence is fine, that is the terms, high level. We agree, no? So we have a deal. Mirko, come on.
1x, okay, we can do that. you're okay.
We have a deal.
Thank you.
So I think, Jimmy, you mentioned the deadline here many times in the end. Is there anything?
They were lingering. I mean, they were so
So to avoid you going away here with a nasty reputation from the audience, is there anything in 30 seconds you will wrap up what you would normally not push for, which you pushed for today?
Yeah, I think generally in your situations you should always have more than one term sheet. So you should definitely talk to more people, and you should also try to coordinate so they arrive at the same time, because if I had been really rude, I would give you a time limit on the term sheet, right? So then you only had, like we had today, whatever, a week to agree. That's one. Then this is a seed stage investment, and I don't know how much the audience could follow about the terms, but they are mega aggressive, right? So first of all, the whole anti-dilution, we're talking about a valuation that's in all bigger scheme of things is fairly low. So usually we would not argue for an anti-dilution at this valuation, to be honest. So that's different taste and preferences. A 2x participating liquidation preference is super aggressive, right? It would be a 1x and with a catch-up, so there would be no participating. That's also unusual. And I think you yielded actually on the valuation, which you yielded way too early. And I gave you only 10% of the warrants, so you're taking 30% dilution for the first round, which is a good deal for me, but I'm not sure it's such a good deal for you. So that's why you need to have alternatives. So aside of that, there's a lot of aggressive things in this one. But I think the vesting schedule, we will always argue for that, and usually we would have a 4-year vesting schedule, actually 25 installments. Because the reality is that founders sometimes don't agree, and then actually you have to go in and fix and replace, and then you need to re-incentivize the people that are then coming in to the team, right? Yeah. So it's pretty common to have that. But aside of that, I think it's a very aggressive one. And one thing is, in the beginning I say, why do you bring your bodyguard, right? You always need to bring your bodyguard. I do more term sheets than you do, and I can easily cream you in the process if you don't have legal counsel, right? So that's an advice to all of you. If you want to negotiate a term sheet, you can do two things. Either you bring an attorney, to the table. That's the one thing you can do. The other thing you can do is to say, let's have a meeting where you explain me the rationale of what it is you want to achieve, and then I go back and think about it, discuss it with council and co-founders, and then I come back to you. But I listen. I don't negotiate. That would be my recommendation.
You don't sign on the day.
You don't sign on the day if you don't have a legal counsel and the consent of your co-founders. So in this, you needed to be much more prepared and already know what your borderlines is with your co-founders and so forth, right? So you don't have to go back and defend and come back, because that's going to be a bad process. And sometimes you only have a week to do it. We usually push time limits. Mm-hmm. So we would usually, like we had now, it's just 45 minutes. We would usually have, maybe a week. If we cannot agree in a week, we cannot agree. We move on.
Mm-hmm. So thanks, guys, for playing along, and thanks for sharing your experience. We're out of time, so let's wrap it. And thanks give them a big hand, please.